Hello and welcome to this Forex Preview at xm.com. We'll be discussing the upcoming Fed meeting and the outlook for the dollar. I'm Maria Bashardis, and joining me is lead investment analyst Rafi Boyadjian. So Rafi, the two-day FOMC meeting will end on Wednesday, and policymakers are widely expected to hike rates by 75 basis points. Given that this will be one of the smaller meetings without new economic forecasts, what should we expect to hear during Chairman Powell's press conference?
Well, Maria, like you said, a 75 basis point rate hike is mostly priced in by the markets, but there is a small risk of a bigger rate hike. Now, it's unlikely the Fed will decide to raise rates by a full percentage point. This comes, of course, after the Bank of Canada did the same, and after we had that CPI beat once again, where US inflation has now reached 9.1%. But we did also hear from two of the Fed's most hawkish members, Governor Christopher Waller and St. Louis President James Bullard, both of whom didn't really see much of a need to go more aggressive than 75 basis points. But there are some concerns about the strength of the US economy. We did just get that negative surprise in the flash PMI by S&P Global, which showed that the services sector did shrink unexpectedly in the month of July. We're also seeing jobless claims slowly creep higher. In fact, it's been steadily rising for the past few months. So again, more evidence that the labor market is cooling down. So investors will want to see, first of all, whether or not a 100 basis point rate hike would have been discussed at the meeting. There's a good chance that they will discuss this. And if they do, then that's going to signal that the Fed is maintaining its hawkish bias. On the other hand, if the Chair Jerome Powell in his press conference, if he doesn't use some language that kind of acknowledges the slowdown in growth, so he sort of plays down the risk to growth, or might say any weakness is likely to be temporary, and it doesn't see inflation pressures having subsided enough just yet to warrant any shift in policy. That could potentially weigh on markets because we are seeing growing risks of recession.
Turning to the dollar now, it seems to be the all-weather currency, doing very well despite concerns about inflation and a global recession. But we do have quite a bit of data coming up in addition to the Fed policy decision. Should we be bracing for a lot of volatility for the dollar in the coming days?
So we could see quite a bit of volatility, or at the very least a lot of choppiness in the dollar pairs. So there's a lot of data, like you said, coming up. The most important one will be Thursday's advanced GDP report. Now, if you remember, we did get an unexpected contraction in GDP growth in the first quarter. Now, this was mainly due to technical factors such as inventories that distorted the data. But the forecast for the second quarter are for 0.4% annualized growth. That's pretty low, so it's not going to take much to tilt that number into a negative. So we could potentially get a technical recession from Thursday's data. We're also going to get on Friday personal consumption and the core PCE price index. Again, how well consumption held up in the month of June, and whether the Fed's most closely watched price gauge, whether or not we're going to get a further moderation in PCE inflation in June. That's also going to be important. But even if we do get negative surprises in these data, and yet the Fed doesn't really change its tone, that could that could potentially upset the markets. But if it's going to hurt the dollar, like you said, the dollar is an all-weather currency at the moment. So even if you do see some short-term, jerkiness or knee-jerk reaction in the dollar to the data, in the broader picture, we're unlikely to see any significant weakness and any sort of a shift to a more bearish outlook for the dollar, as long as the dollar is maintaining its safe haven status.
Rafi, thanks so much. And thanks for joining us at xm.com.